I'm Dennis Tubbergen. You are listening to the Retirement Lifestyle Advocates radio program. Glad you decided to listen in today. Hey, joining me on today's program is my special guest, market analyst Murray Gunn. Murray is an analyst with Elliott Wave. I'm going to get his forecast for where he thinks markets go from here. And it is the last opportunity for you to get my May special report if you'd like to receive it. The May special report is titled How Evolving Money Affects Financial Markets. You can get a copy of the report as well as some bonus information I'll be glad to include with the report by visiting requestyourreport.com. The website again, requestyourreport.com. This report does a deep dive into the relationship between evolving money, and of course, money is evolving today by being devalued. And we take a look in the report at what happens when currency is devalued and how do financial markets typically react. I think you'll find the information in the report to be offered to you from a very unique perspective, and I'd encourage you to order your free copy. Again, today's the last opportunity to get that by visiting requestyourreport.com. The website again, requestyourreport.com. You know, back in May, I put together the client newsletter that I send out to clients every month called the You May Not Know Report. And in that report, as it was hitting mailboxes, I wrote about an indicator that was talking about or that was indicating a strong probability of a stock market correction. Now, this is what I wrote a little over a month ago at this point. An historically reliable predictor of stock market corrections just signaled that a deeper stock market correction may be coming. Margin debt declined meaningfully. Now, if you're not familiar with margin debt, it's a loan that is issued by a broker-dealer using the equity in an investment account as collateral. So basically, it's a loan using, if you will, stocks in your investment account as collateral for the loan. Now, as a side note, if you have an IRA or a tax-qualified account, you cannot use margin in the account. It's got to be an account that is not an IRA. It's got to be what we would call a non-qualified account. Now, margin debt rules require that an account have at least 50% equity. So if you have a brokerage account with a $1 million balance, it's eligible for a margin loan of $500,000. Now, if the $1 million in securities were to appreciate to $1.5 million, now the margin loan amount could be increased to $750,000. As long as that 50% equity is maintained, as securities in this account appreciate, you can also take on more debt. Now, if the value of the securities in the brokerage account falls to less than 50%, the margin loan has to be paid down because you have to have at least 50% equity in this account at all times. Now, if you think about it, I'm sure you'll find that it's logical that there are two ways a margin loan can be paid down to get back to this 50% required equity. One, you simply add more funds to the account until there's once again 50% equity. You add money to the account. Or two, you sell securities until the account once again returns to 50% equity. Now, it's often this second method that is used. Often, securities are sold until the account gets back to 50% equity. So essentially what happens is the value of the securities in the account is reduced, increasing the value of the cash in the account, getting that balance back to 50%. Now, historically speaking, whenever margin debt has started to fall, it has been a fairly reliable leading indicator when forecasting stock market declines. Now, just for comparison's sake, I think this is pretty interesting. At the peak of the tech stock bubble, going back to 2000, when the tech stock bubble started to unwind, total margin debt was about $500 billion. In 2007, at the market peak, at about the time of the financial crisis, it was just under $600 billion. When I wrote the May newsletter that went to my clients, I noted that margin debt had risen to nearly $1 trillion before it began to decline, and it declined by about $120 billion. So as the May newsletter was hitting mailboxes after I had written this and said, I think we have a strong probability of a correction, stocks started to fall. Now, as I am recording today's program, the S&P 500 has fallen from, at the beginning of the year, about 4,800 now to about 3,900. So we are right at the point almost that we have an official bear market, which is often measured or defined as a 20% decline. Now, when you look at market statistics of late, and you compare these statistics to other historical time frames, it's been a tough stretch for stocks. Bloomberg reported that the S&P 500 has now declined 7 straight weeks. Now, again, that's as I am recording this. It's the worst losing streak since 2001, which was when the tech stock bubble was unwinding. The Dow is down 8 straight weeks. That's the worst losing streak since May of 1923. It's 99 years since the Dow has experienced this many down weeks. Now, markets rarely go straight up or straight down. So from where we are now, I believe this doesn't have to happen, but I think the probability of a rally is pretty likely. When prices reach extremes, when prices fall or rise too far over long-term moving averages or fall too far under, as the case may be, we often see a reversal in price. So that would indicate that we would see potentially a rally in stocks here, which, again, would not be surprising. However, I believe the primary market trend is down. That will likely mean a series of lower highs and lower lows from this point, even though we're likely, it's possible anyway, I think highly likely that, in my opinion, that we see a rally from here. Now, meanwhile, the economy, and I'll talk about this more in the fourth segment of today's program as well, the economy is not very healthy. In fact, many of you have been longtime listeners to the program, know that in the first quarter of this year, on this program, I made the statement that I believe the United States was probably in a recession. Now, I still believe that's the case, and there's some news stories now that are jumping in and agreeing that that may be the case. I'll talk about those in just a minute. However, when you look at economic growth to this point, that growth has occurred because of artificial stimulus. Federal Reserve currency creation and massive levels of government stimulus have simply masked, in my view, the real state of the economy. But now that government stimulus has dried up, the real state of the economy is becoming more obvious, and there is a stunning development, in my view. Consumer credit card debt doubled from February to March of this year. I did not misspeak. Consumer credit card debt doubled from February to March, which leaves little doubt as to how consumers are actually dealing with rampant inflation. Now, Zero Hedge reported that February credit card debt levels were $14.2 billion. That rose to $31.4 billion by March. That is a huge increase. And interestingly, credit card debt is rising as interest rates are as well. And credit card debt went up, and there was no Christmas holiday. There were no Hallmark holidays, if you will, in there. So it just simply tells you that because the personal savings rate is down, people are dealing with this additional inflationary pressure by using their credit cards. And we all know that is a trend that cannot continue. Now, as far as recession is concerned, CNBC reported this, and I quote, "The U.S. economic contraction to start the year was worse than expected as weak business and private investment failed to offset strong consumer spending. I just told you how that consumer spending was financed. First quarter GDP, this is CNBC, declined at a 1.5% annual pace. Economic contraction, declining GDP, is the definition of a recession. So I believe we're there. I believe that if you're managing money the way you always have, you should get a second opinion, and that's why I'm offering my special report for the month of May titled How Evolving Money Affects Financial Markets. I'd be very glad to send you a copy of the free report by visiting requestyourreport.com and letting me know where to mail the report. I'll be very glad to send it to you. Again, the website, requestyourreport.com. And I'll be glad to send you my May special report, How Evolving Money Affects Financial Markets. I will return after these words with my special guest, Mr. Murray Gunn. Welcome back to RLA Radio. I am your host, Dennis Tubbergen. Chatting with me on today's program once again is returning guest, Mr. Murray Gunn. Murray is a market analyst at Elliott Wave International. And Murray, welcome back to the program.
Thank you, Dennis. Great to be here.
So, Murray, for our listeners maybe that are not familiar with Elliott Wave, could you give them just a basic crash course, please?
Sure. Well, the Elliott Wave principle is what we call a fractal-based model of the economy, discovered by a man called Ralph Elliott in the 1930s. And what he discovered was that human herding behavior causes markets like the stock market, which is a leading indicator of the economy, to exhibit certain identifiable and repeatable patterns. And he found that these patterns repeat at every time scale, and so it enables cycles of herding behavior to be anticipated from the short term to the very long term. And what Elliott did was, he didn't really have a theory about this. He was an accountant by his profession for most of his career, so he wanted to have a detailed analysis, and he examined the price data of the US stock market. And so this empirical study brought out this pattern recognition. And what actually he did was introduce a forecasting element to what was then the popular market forecasting and market analysis at the time of the Dow theory, and that wasn't really appreciated until Elliott discovered the wave principle.
So, Murray, for our listeners' benefit, explain a bit about your background and how you got to be working with Elliott Wave and what it is that you do day to day. Excuse me.
Well, I've been working in the financial markets now for a little over 3 decades, mostly on the fund management side, with companies around the world, from Standard Life in Scotland to Abu Dhabi Investment Authority over there in the Middle East. In the last decade, I've been involved mainly on the analytical publishing side. Worked with as the head of technical analysis for HSBC, and the last few years with Elliott Wave International. And so my day-to-day role is to analyze the global financial markets, concentrating mainly on the European markets as well as the bond and credit markets and the foreign exchange.
So, Murray, we have had a very eventful couple months in stocks. Our listeners are worldwide, but predominantly here in the U.S. So in looking at the S&P 500 and the Dow, seems they're in or at least approaching very closely an official bear market. What's your assessment of stocks, both in the U.S. here to the extent that you can talk about it, and then worldwide, and what's your forecast?
Sure. Well, I think when we last spoke in January, I reiterated our view then that the bounce in the global stock market index from the 2020 pandemic lockdown lows was the final rally in a multi-decade bull market and that 2021 in particular could have marked an historic juncture in the what we call the supercycle topping process. And that seems to be playing out now, with the stock markets down over the last few months. Obviously, bond yields up. We've had a very grisly bear market in the bonds, and now corporate credit is coming under pressure as well, which is relatively new over the last few weeks. So there'll be bounces along the way, but if our model is correct, then this is just the start of a trend which could last for many months, if not years.
Well, for our listeners that would like to go back and check out the interview that Murray did here about 5 months ago, you can go to retirementlifestyleadvocates.com and look at our archived podcasts, and that's indeed exactly what Murray forecasts. So, Murray, how low do you think stocks can go from here? When you say this is a multi-decade top, that sounds ominous.
Well, certainly it's a trend, and if you look at the history of bear markets, a lot of people look at the history of the U.S. stock market in particular, which is fair enough, and bear markets, there hasn't really been an elongated bear market for the last 100 years or so. I mean, certainly the depression of the 1930s, the bear market in stocks was over within a couple of years before it bounced off the 1932 low. But if you look at other markets like Japan, Japan topped out in 1989 and is still not above that 1989 high. So there are precedents, if we're arguing into what we think is this is the sort of end game of a supercycle top, which started with Japan and went through Europe, went through China. All these markets have topped out or gone sideways over the last couple of decades. And the U.S. was really sort of the last man standing. Probably the main thing which is sort of spooking investors at the moment is the absence of the so-called Fed put this time. The Fed put meaning that the Fed has historically acted as a put option for investors because it eventually comes to the rescue of the markets. In actual fact, this has just been a recent phenomena over the last couple of decades or so. It never used to be like that. I mean, Paul Volcker's Fed didn't give two hoots about the stock market back in the late 1970s. And we think that the conventional causality in this regard is wrong, in our opinion. It's not the Fed that saves the market, so to speak. It's the positive trend in social mood which allows the Fed to act. So now that we think, and the evidence suggests that social mood is turning negative, we don't think the public will be so acquiescent for the Fed to intervene. And a lot of it has to do with the speed of the move as well. There's probably no doubt that if there were to be a kind of fast crash-like situation, then the Fed and other central banks would try to intervene. But a steady downtrend in the stock market, which is what we're seeing at the moment, is not going to float the Fed's lifeboat, so to speak, this time, given the fact that it wants to tighten monetary policy in order to combat consumer price inflation.
Murray, isn't really the Fed in a very difficult place here? I mean, if they don't intervene, as you described, you're going to see likely a market correction. And, you have forecast, as well as Bob Prechter many years ago, that we're going to have to see a deflationary environment. And if they try to intervene, they feed this inflation monster. So, I mean, can the Fed win here?
Well, that's right. They are as central banks are in a very difficult position, and it's a position they've put themselves into by the incredible, unprecedented monetary inflation that they've gone about since 2008. And I think you really have to look at the bond market for this regard. And Elliott Wave International have realised for decades that it's not the central banks that lead the market, it's the markets that lead the central banks. And so the Fed and other central banks tightening has come now is coming through this year because the markets have been dictating to the central bank, saying you have to actually hike rates, you have to tighten monetary policy, because the bond yields have been going up since over the last couple of years, something which we've been telling our subscribers about over the last 18 months, certainly, that to be aware of this bond bear market that was coming. And I think, again, the last time I was on, I think it was I mentioned that it was the Clinton advisor, Jim Carver, who said that when he died, he wanted to be reincarnated as the bond market because the bond market intimidates everybody. Well, it's certainly intimidated a lot of people this year. So yes, absolutely, the Fed and other central banks, they're kind of damned if they do and damned if they don't.
So this talk of a soft landing, do you see that as being a possibility? Or, last time you were on, and for our listeners that might like to reference it, and if you're just joining me, I'm chatting today with Murray Gunn of Elliott Wave International. The website is elliottwave.com. There's also a free book available there. And if you go to our site, retirementlifestyleadvocates.com, we'll post the podcast version of this program there. We'll have a link so you can get that free book explaining Elliott Wave as well. So what's your take, Murray? Is a soft landing a possibility, or are we headed for kind of a redo of the 1930s in your view?
Well, it's after such an unprecedented bubble, which has been going on not just for the last couple of years, but really since Nixon closed the gold window back in the 1970s, and since fiat currencies started, there's just been this incredible bubble in debt, and this is the sort of 800-pound gorilla in the room that people don't really want to focus on. And the fact that the debt, not just public debt, which we all kind of know about, is through the stratosphere, but private debt, and especially if you look at non-financial U.S. corporate debt, that's at the historical extremes, and what that means is that as interest rates rise, the debt burden becomes intolerable. And so therefore you have this situation of debt deflation where companies and individuals are forced to reduce their debt, pay down their debt, or default on their debt. So it's very difficult to see, if our model is correct, and we do have this downtrend in the stock market driven by negative social mood, then it's very difficult to see a soft landing.
Well, my guest today is Mr. Murray Gunn. The website is elliottwave.com. Murray is graciously offering the listeners a free book as well. You can go to elliottwave.com or visit retirementlifestyleadvocates.com, and we'll post a link there as well. I'll continue my conversation with Murray Gunn when RLA Radio returns. Stay with us. I'm Dennis Tubbergen. You are listening to RLA Radio. My guest today is Mr. Murray Gunn. He is an analyst with Elliott Wave International. The website is elliottwave.com. You can go there and request a free book about Elliott Wave. You can also visit retirementlifestyleadvocates.com. We'll have that link posted on our podcast. So, Murray, you said something that I think maybe piqued the interest of some of our listeners in the last segment. You mentioned that there's a link between social mood and stock performance. At least that's what I thought I heard you say. Could you explain?
Sure. Well, Robert Prechter's socionomic theory is a field of study conducted really under the hypothesis that waves of social mood motivate the character of social actions, not the other way around, as most people believe. So it's the waves of social mood which drive the stock market. Human beings drive the stock market at all times. So the mood of the people, the mood of the herd, drives the stock market. And so the stock market is actually our gauge of social mood, or we call it a sociometer. And so our historical research has found that positive social actions, such as things like peace, inclusion, and consensus, they tend to proliferate with a positive social mood. and a rising stock market. On the other hand, negative social actions such as war, exclusion, and disharmony really tend to proliferate with a negative social mood and a declining stock market. And we had an amazing example of this this year with Russia's actions in Ukraine. The Russian stock market, if you look at the RTS dollar index, the Russian stock market topped out in 2007, and so it's been in a declining trend since then. And you know, way before then, Elliott Wave had published about Russia and identifying the fact that it could, if it went into a bear market, have some serious repercussions. And over the years since then, we've mentioned it a few times. And coming into this year, we noticed that the pattern was certainly coming into what we call, getting a little bit technical here, but we call it a triangle pattern. And what we said to our subscribers in January of this year was that the pattern of the stock market, because it's driven by social mood and because negative social mood results in negative social actions, we said in January that it was probably highly probable that Russia would go into Ukraine. And so the not to get too doom and gloom about it at the moment, but there's a very similar pattern happening at the moment in China. If you look at the Chinese stock market, it topped out in 2007 as well. So there's been a 15-year negative social mood trend in China, which has driven the stock market sideways to lower. And given the historical research that we've done, after periods like this, so we're coming into this sort of peak negative social mood period in China, and so we should be on the lookout for negative social actions. And of course, we could say that we're already seeing that with the likes of what's happening with the Uyghurs and the lockdowns, the strict lockdowns in China.
So, Murray, I want to go back and examine something that you mentioned, that we've got this big bubble in debt. And I think a lot of our listeners maybe don't completely understand or would like to maybe understand to a greater extent the link between debt and bubble creation.
Well, sure. I mean, it's at the end of the day, Dennis, it's all driven by social mood. And so as social mood is trending positively, then people feel happier, they feel more optimistic. Because they feel more optimistic, they want to take on more debt, or they feel happier taking on more debt because they don't see anything bad happening in the future. And so the debt comes on, whether that's in the form of debt to buy a bigger house or debt to invest in the stock market, or even, as we've seen recently, debt to invest in the crypto bubble, which is quite alarming. But this is what it's all about. Is that the positive social mood means that people want to take on debt, leverage, and that fuels the stock market bubble.
So, Murray, when you were on, in fact, in January, it was January 23, so a little over 4 months ago, you forecast that the bond market was ready to start declining. So let's talk a bit about that, if we could. When you look at government debt, worldwide, and again, most of our listeners are here in the U.S., we have debt levels and unfunded liabilities that can never be paid. So given that we've just had a literally 40-year bull market in bonds, what are you forecasting as far as this bond bear market is concerned?
Well, it might come in a couple of phases, and we're certainly seeing the first phase at the moment. Obviously, with bond yields over all sectors, not just government bonds, but in the corporate sector, being so artificially low for the last decade or so, helped a lot, a huge amount, by the quantitative easing and the money printing that was going on by the central banks. with those bond yields being so low, it encouraged a very high duration in the bond markets, a very high what we call duration sentiment, duration allocation in the bond market. And that meant when the bond market did finally snap and yields started to go higher, it meant that the price decline was even greater. And so up until the last few weeks, we've seen the main part of the bond market, the bond bear market this year, has been concentrated around the fact that rates have gone up and yields have gone up, which has caused, obviously, the price to go down. What's interesting now is that we're going to be seeing the second phase of the bond bear market, in that, up until recently, what we call corporate credit spreads or corporate bond spreads, so the yield spread between, say, junk bonds or higher quality bonds relative to US Treasuries, they'd remained relatively stable. But over the last few weeks, they've started to accelerate higher. And so what that means is that people now see the differences from maybe, February, March time, where people didn't really see the effect that the rise in yields was having on growth, that now people are thinking, well, the economy probably is going to go into recession, and therefore the risk of corporate default and what we call yield spread widening is going up. And if you look at what happened in previous cycles, certainly in the Great Depression, corporate credit or corporate bond yield spreads were much higher than they are currently. So there's a lot of scope for a bear market in the corporate bond market now, as opposed to the government bond market. But we still think yields across all sectors will continue to go higher.
So, Murray, big picture economic question, if I could, please. There are those that are in the camp that the Fed will reverse course and we're going to see a hyperinflationary outcome, a hyperinflationary depression, if you will. There are those in the other camp that say, no, we're going to see a huge period of deflation. Do you have an opinion on that?
Well, we've seen the inflation already. I mean, the Fed has been hyperinflating since 2008, and that's the reason why, or one of the big reasons why, the asset markets became inflated, and now obviously that's feeding through into consumer prices. In a very broad macro sense, it's interesting what's happening at the moment, which points towards the deflation side. If you look at, actually, very relevant for this week, the World Economic Forum is back on in Davos this week, and deglobalization is a term which is appearing to be on everyone's lips at that event this year. Of course, the supply chain issues of the global economy have been given great prominence, not least with obviously the war in Ukraine, heightening concerns about food shortages, especially in poorer nations. But a potential reversal of the decades-long trend in globalization seems all of a sudden to be the big issue. Now, if you look at the data, actually deglobalization started back in 2008. If you look at the value of global exported goods as a percentage of the world economy, that actually topped out in 2008, the year of the Great Financial Crisis, and has been declining, since then for over a decade, after a multi-decade advance that it had from 1945. But this decline in globalization should really worry us all. Again, not to be too doom and gloom about it, but the previous decline in globalization on this measurement of global exported goods as a percentage of GDP, world GDP, that happened from about 1912 until 1945. And of course, that deglobalization period corresponded with two world wars and a major depression across advanced economies. And so you add to that, what I just mentioned earlier on about Chinese social mood being trending negatively for 15 years now. It points to a potentially very precarious future in the years ahead.
Well, unfortunately, the clock says we're going to have to leave it there. My guest today has been Mr. Murray Gunn of Elliott Wave. The website is elliottwave.com. If you go to elliottwave.com and click on the resources link, you can get a free Elliott Wave Principle book. Explains the key to market behavior. And again, that is absolutely free. We'll also have a link on our website at retirementlifestyleadvocates.com. Murray, always a pleasure to have you on. Always appreciate your perspective very much and would love to have you back down the road. Thank you for joining us today.
Thank you, Dennis.
We'll return after these words. This is the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen. Thanks again to my special guest today, Mr. Murray Gunn, for joining us on today's program. Hey, if you've not yet requested your copy of my May special report, today is the last day that you'll be able to order that. The report is titled How Evolving Money Affects Financial Markets. It's a deep dive into the relationship between a devalued currency and the performance of various asset classes in the market. I'd love to send you a complimentary copy. Visit requestyourreport.com to order your copy of the report. When you go there and let me know where to mail it, I'll also be glad to send you some bonus information that I think you'll find to be very useful. Well, if you listen to the first segment of today's program, you know that I have been forecasting a decline in stocks for quite a long time. Now, I believe that the most recent decline will likely not continue straight down. I believe we'll see a counter-trend rally, but I believe now, in my view, by my metric, I believe that the primary trend in the stock market is down. In this segment, I want to give you my view on real estate. I believe that real estate prices, even though they're still holding their own, and the real estate market rather seems strong, I believe that all that is now about to change. Bottom line is, if you're thinking about buying real estate now, I would be cautious. If you're thinking about selling real estate now, I would hurry. Wolf Street said this, quote, "Sales in the U.S. of previously owned homes, houses, condos, and townhouses fell 2.4% in April from March. That's based on seasonally adjusted annual sales, and they're down 5.9% from a year ago. House sales are down 4.8%. Condo sales down 13.9%, according to the National Association of Realtors. It was the 9th month in a row of year-over-year declines, even as supply of homes listed for sale continued to rise. Those are both negative developments for real estate, in my view. Now, the National Association of Realtors report said this, and I quote, "Higher home prices and sharply higher mortgage rates have reduced buyer activity. It looks like more declines are imminent in the upcoming months." The seasonally adjusted annual rate of sales of 5.61 million was the lowest since June of 2020. Sales of single-family houses dropped 2.5% in April from March, and by 4.8% year over year, as I just mentioned. Now, CNBC, quoting them twice on today's program, had this to say about mortgages. Mortgage rates actually fell slightly last week, but the damage has already been done to housing affordability. Both refinance and purchase loan demand dropped, pulling total mortgage application volume down 11% for the week. That's according to the Mortgage Bankers Association's seasonally adjusted index. Mortgage applications to purchase a home declined 12% week to week, and were 15% lower compared with the same week 1 year ago. This was the first weekly drop in home buyer demand since the third week in April. Mortgage rates have risen over 2 full percentage points since the beginning of the year, and home prices are up more than 20% from a year ago. You don't need to be an economist to know that those two developments are going to eventually be negative for the housing market. And interestingly, when you compare the state of the housing market today to the state of the housing market prior to the real estate decline at the time of the financial crisis, and you look at it from the perspective of interest rates, what you find is very interesting. Interest rates now at just north of 5% are about where they were at the low point of the interest rate cycle at the time of the financial crisis. So the bubble in real estate from, let's just say, about 15 years ago, occurred by having interest rates drop to 5.25%. This bubble formed with interest rates on a 30-year mortgage dropping as low as 2.75%. That should give you some perspective as well. Now, the average interest rate today on a 30-year fixed mortgage, now last week it dropped to 5.49%. It was 5.53% the year before. Now, there's another issue here when it comes to the housing market. Inflation is not helping consumers feel particularly comfortable with the market. Now, economist Joel Kahn had this to say: general uncertainty about the near-term economic outlook, as well as recent stock market volatility, may be causing some households to delay their home search. Certainly, when you see a market decline of nearly 20%, that's a lot of wealth that has evaporated. That certainly affects the real estate market as well. Now, applications to refinance a home loan are down huge. Refinance demand, get this, down 76% from 1 year ago. Nobody wants to refinance at 5.5%, but at 2.75 or 3 has started to make some sense. So I believe that real estate will soon follow stocks. As I mentioned in the first segment, I believe that the primary trend in stocks is down, although I believe that we may see a rally near term. My June special report will be a mid-year update. We'll take a look at analyzing all the markets. We'll look at stocks. We'll look at U.S. Treasuries. We'll look at gold. We'll look at silver. We'll look at wheat. We'll look at corn. Give you our forecast for all those markets. Be sure to tune in next week for that report offer. If you have not yet requested the May special report, today is your last opportunity to do so. The May special report is titled How Evolving Money Affects Financial Markets. It's a deep dive into the relationship between devaluing currency and the performance of investment markets. Again, the report for the month of May, last opportunity to get it today, How Evolving Money Affects Financial Markets. To get your copy of the report, visit requestyourreport.com. The website, again, requestyourreport.com, and I'll be very glad to send you the report as well as a bunch of bonus information. It is all free. It is all without further obligation. We are all about education here at RLA Radio. If you're not yet visiting retirementlifestyleadvocates.com, a lot of free resources there as well. The podcast version of the radio show is there, as well as my weekly headline roundup alternative newscast that happens live every Monday at noon, but all the webcasts are recorded and they're posted at retirementlifestyleadvocates.com. I'd encourage you to check it out. That's all the time I have for this week, but I'll be back again next week. Hope you will be too.